Hello, welcome back. Today we're going to start our second unit of the course, kind of our second breakout for exam number 2. As you remember, exam number 1 covered chapters 15 and chapters 20, and today we will pick up with chapter 16, and then the following lectures will be covering chapter 17, and those will be the two chapters you will be responsible for on your next exam. Chapter 16 covers dilutive securities and earnings per share. Before we kind of dive into it, I want to note that a lot of the material in this chapter kind of corresponds with a lot of the material we covered in chapter 15. So some of the things overlap, and you may have to use some of the information from chapter 15 in completing your work for this chapter. But basically, this chapter is going to examine the issues related to accounting for dilutive securities at the date of issuance and at the time of conversion. Basically, we are going to figure out how these dilutive securities impact earnings per share and the significance that they have for stockholders and potential investors. All right, let's dive in. Starting off, we're going to focus on dilutive securities, and then we'll jump into earnings per share after that. First, as defined, dilutive securities are those that are not common stock in form but enable their holders to obtain common stock upon exercise or conversion. The most notable examples of these are convertible debt, convertible preferred stock, stock warrants, and stock options. We will focus most of our time on convertible debt and convertible preferred stocks, but we will touch base with stock warrants and stock options. The key reason that convertible securities are often called dilutive securities is because upon being exercised, they may reduce, which is diluting the company's earnings per share. So if the dilutive security causes a company's earnings per share to go down, then it is a dilutive security. If it causes their earnings per share to go up, it is not a dilutive security and is actually anti-dilutive to the earnings per share. There's a few reasons why a company would issue convertible debt. The first is that they can raise capital without giving up too much control of the company, and we have an example here that we'll walk through to kind of show you why that is the case. In this example, Company A wants to raise $1 million with their stock currently selling at $100 per share. If they were to issue shares to obtain this $1 million, they would have to issue 10,000 shares of their stock for the company. However, if they raise the money using convertible debt, they could sell 1,000 bonds that are each convertible into 8 shares of common stock. Therefore, if the people purchasing these convertible bonds elect to convert them, the max number of shares that could be issued is 8,000. Therefore, they are giving up potentially less ownership if they do the convertible debt as opposed to issuing the equity and just issuing shares of stock. The second reason is that they can often obtain debt financing at cheaper rates. One of the key reasons that convertible debt is enticing for companies is because the conversion feature entices investors to accept a lower interest rate than they normally would if they were just accepting a traditional bond that doesn't have any conversion features. So this allows them to kind of manipulate the market and the time when interest rates are high or interest rates are low to use these features to their advantage. Reasons why you would want to purchase convertible debt. So this is from not the mindset of the company, but the mindset of the investors who would be looking to purchase this debt. And the primary reason mine is that you get the initial security of being a debt holder, followed by the future option to be an equity holder and earn a higher return than on the debt. Therefore, if you start by buying this and you have it as a debt holder and the company is not doing very well, then you would maybe maintain holding onto your debt. However, if the company's shares dramatically increase over the time you have this convertible debt, then you can convert the debt into equity, and therefore you can take advantage of a company's stock price increasing, and therefore you will be better off in the long run. First, we're going to start with the accounting for convertible bonds. So, with respect to issuance and interest dates, these follow the methods used to record straight debt issuances, in which none of the proceeds are recorded as equity and they are all booked as debt and then amortize the premium or discounts over the life of the convertible bond. This information was covered in a previous chapter that's not part of this course, and I'm not exactly sure if you've covered this material in detail. So you will not be required to calculate any of the present value of the future cash flows or recognize any amortization or premium, as any example that I provide will give all the necessary information you need to complete the question. Regarding conversion of convertible bonds, it is recorded using the book value approach. And the simplest way to remember this is that under the book value approach, the debt goes away and the equity comes on, and there is no gain or loss. So you started with debt issued. When you bought the convertible bond, there was debt issued. Therefore, you have the debt on your books. However, when it converts, the debt goes away and the equity comes on, but there is no gain or loss recognized on that conversion. So let's go through an example. Jayhawks Inc. issued 10 8% $1,000 par bonds at 110, which represents 110% of the total of the par value. Each bond is convertible into 100 shares of $5 par value common stock. So, let's record the entry at the date of issuance. And here's a tip for you. At the issue date, you ignore the fact that there is a conversion feature where the debt would become equity. So, Jayhawk Inc. issued these bonds, so they would get the $1,000 in cash, and the $1,000 in cash represents 10 times 1,100, because these sold at 110% of par, which is 1,100. So and that 1,100 is 10 times 110. So that is the entry made to cash at the date of issuance. You record the bond at 10,000. This is because this account is reported at the par value. Therefore, 10 bonds times $1,000 pars equals 10,000s. And consistent with what we did with common stock when we were recording additional paid-in capital, you need to recognize the additional balance, which is represented as a premium on the bond payable. In this circumstance, this is where this $1,000 would be amortized over the life that you hold the bond. We are going to ignore that feature for now, and assume that only $500 of the premium has been amortized. So I will give you the information in the next part here that tells you how that account is going to change. So, continuing from the previous example above, the 10 bonds were converted into 1,000 shares of $5 par value common stock when the carrying amount of the bonds were 10,500 and the market price of the stock was $12 per share. This balance, the 10,500, represents the $10,000 that were in the bond payable from above, plus 500 of the premium bond payable that is remaining. So the other 500 are amortized off, but you need to know that the carrying amount of the bond itself is the bond payable plus the premium bond payable. So, as we noted above, the first thing you need to do is close the debt. So, we remove the $10,000 bond payable from above, and we remove the remaining premium from the bond, which is 500 because of this value right there that tells you the excess remaining is 500. Then you record the common stock. And this is where it relates to chapter 15 and how you record common stock between common stock and the additional paid-in capital count. As you remember from the common stock entry in chapter 15, it is the par values. Therefore, the 1,000 shares that the bonds are being converted into times the $5 par value of the common stock is what is recorded in this account. Therefore, as you can see, the $10, the 10,000, and the 500, that is 10,500, and you need to get to offset that because you need your debits and your credits to offset in this formula. Assets equals liabilities plus owner's equity. Therefore, you make a plug entry to additional paid-in capital. I will let you know, please note the market price does not come into play in this example. I do not want you to get confused and think that when you see that value that you need to take 12 minus 5, which equals 7, and then record 1,000 times 7 like you normally would have in the additional common stocks. That is not how it works for convertible bonds, and the reason is because you amortize the premium over the life of the bond. And here is the question, kind of going through that, but further highlight. Using the book value approach, when the debt comes off and the equity comes on, there are no gains and losses reflected. Therefore, the market value at the date of the conversion is not going to play a role in this. And I missed up here. This just kind of goes through what I said. The first step is you close the debt, and the second step is you book the equity and you plug the additional paid-in capital as applicable. Please note that in this example we converted all of the bonds issued. However, this may not always be the case on homeworks or exams. So there may be a situation where we only convert 5 of the 10 bonds, and you would still do the entries accordingly. Now we're going to focus on induced conversions. Sometimes the issuer of debt wishes to encourage prompt conversion of the convertible debt to equity. They often will entice the investors to do this conversion by offering them additional consideration, either in the form usually of cash or common stock, and this is referred to as a sweetener. To provide a little bit of information on this, one reason why the issuer would want to encourage this prompt conversion is to take advantage of changes in interest rates. They may issue the convertible debt when it is in their favor. However, things may change in the interest rate environment where it is more beneficial to the issuer if you have the equity as opposed to the debt. Additionally, companies will often encourage this conversion as it does eliminate debt from their balance sheet and improves key financial ratios. Therefore, if a company has debt to equity ratios or certain financial ratios that they have to maintain with their lenders and their creditors, then by enticing you to convert your debt to equity, this could improve those ratios and keep them out of any action level events. Key thing to note with the sweetener, it is recorded as an expense in the period incurred. So when I, as the issuer, entice you to convert and I offer you $50,000 in cash, that $50,000 is recorded in the current period. Retirement of convertible bonds. If you have convertible bonds and they retire without being converted into equities, you can retire for cash instead of being converted is one way. You would record the same as any other bond or note with any gain or loss included in income. This is the only thing you need to know, is that if the bonds are retired for cash instead of being converted, any gain or loss, and I'm actually going to just delete that, any gain or loss is included in income. If they are not converted or retired, then the security will expire as debt at maturity. And this is a scenario where you have the ability to convert from debt to equity, but you chose not to, and the bond expired. So the contract for the bond ran out. Therefore, it is just going to expire as debt at maturity, and at that time, the par value will equal the carrying value, and nothing else occurs. You would just pull the balances off the books accordingly. Before we move on to convertible preferred stock, I just want to go back to this retirement real quick just to make sure you understand that Part A is when you elect to retire for cash instead of being converted. And the second one, Part B, is if it is not converted or retired, and then it just expires at maturity. Accounting for convertible preferred stock. This is accounted for at issuance in the same manner as non-convertible preferred stock that we covered in Chapter 15. The conversion date, it is a book value exchange. Preferred stock comes off the books and common stock goes on the books. Therefore, it is a book value trade. No gain or loss on equity transactions. This is an all equity transfer. You will remember that from Chapter 15 about the impact of owner transactions on the income statement. Let's go through an example. Royals Incorporated is issued 100 shares of $100 par value, 6% convertible preferred stock at $110 per share. Each share of preferred stock is convertible into 10 shares of $5 par value common stock. Your first step is to record the entry at the date of issuance. The shares at issuance is 11,000, which is the 100 shares times $110 per share. That is the dollar amount of the share issuance. And therefore we will record that. So because you were issuing these shares, you received $11,000 in cash, which is this calculation right here. You recorded the preferred stock, which, as you remember from Chapter 15, is recorded at par. Therefore, it is going to be 100 shares times the $100 par value. And as you see, that equals 10,000. And similar to Chapter 15, you would record the excess between the amount paid and the par value in the additional paid in capital preferred stock account. The second part here is to determine the entry made at the date of conversion. So the 100 shares of preferred stock were converted into the common stock, and this is into 1,000 shares of common stock. And this comes from the 100 shares of preferred stock and that fact that each was convertible into 10 shares of common stock at a $5 par value. So, as we just briefly mentioned above, at the conversion date, It is a book value trade. You pull off the old and you record the new. So first we need to pull off the preferred stock of 10,000. We need to pull off the additional paid in capital of the preferred stock. We need to record the common stock, which is going to be the $5 par times the 1,000 shares. And then the additional balance excess goes to additional paid in capital for common stock. As you can see, to our formula here, assets equals liabilities plus owner's equity, these all offset each entry, 1 and 2. So as 2, we pulled off all of the preferred stock that was related to the convertible preferred stock, and we recorded the entries to common stock accordingly. This is very basic in nature, in that the key thing to remember with convertible preferred stock is at the conversion date, it is a book value trade and there is no gain or loss on the equity transaction. It is simply pulling the preferred stock off the book and the common stock going on the book. Please note that in this example we converted all of the preferred stock, but this may not always be the case. Additionally, I would like to point out that in this example, the book value of the preferred stock was greater than the par value of the common stock, which is what led to the entry to increase the additional paid in capital of common stock at the conversion. However, please note, if at the conversion date the par value of the common stock is greater than the book value of the preferred stock, for i.e. the amount removed from preferred stock is less than the amount recorded to common stock. So in this situation, this is where the amount that we would record here to common stock is greater than the amount that we pulled off of preferred stock. And as in this example, you can see that we actually booked less to common stock than we booked to preferred stock. In that scenario, then an additional entry is required. Then you will record a entry to debit retain earnings, thus lowering stockholders' equity. This is consistent with how we recorded transactions in chapter 15. So please do not be surprised if you see a question similar to this show up on an exam, homework, or quiz. The key is understanding that when you're putting on something greater than what you're pulling off, you have to have an offsetting entry to represent the decrease to retained earnings. Next, we're going to cover stock warrants. Stock warrants are certificates entitling the holder to acquire shares of stock at a certain price within a stated period. When they are exercised, the holder will have to pay a specified amount of money to obtain these shares. These are normally issued as an equity kicker to make the security more attractive, i.e. a sweetener that we talked about previously. Also issued normally with the preemptive right to purchase additional shares given to existing shareholders, and then also compensation to executives and employees. This is a very common thing that employees will receive, like CEOs of companies. They will receive lots and lots of stock warrants which entitle them to obtain shares at certain prices in a certain period. Usually these prices are favorable to the person purchasing these shares. There are two types of stock warrants. One is detachable stock warrants, and the second is non-detachable stock warrants. First, we're going to start with detachable stock warrants. These can be traded separately, i.e. detached from the stock or the debt that they are associated with, and therefore have a market value. There are two methods in which we will account for that you can account for this. We will focus on the proportional method primarily, but this is used when the fair value of each piece, both the warrant and the equity, is known. This is accounted for exactly like you did in chapter 15 for stock issued with other securities, in which you had to come up with the proportional amount of fair value to determine how the proceeds were allocated. So, as an example, ABC Company issued 1,000 bonds with a fair value equal to $980,000. Each bond had one stock warrant attached, which had a fair value of $25 per stock warrant. Therefore, the fair value of the bonds were $980,000. So we know the fair value of the debt. Now we also know the fair value of the equity, which is the stock warrants, and we know that there is one stock warrant per bond, and there's 1,000 bonds, so we have 1,000 warrants times each warrant's fair market value of $25 equals $25,000 in equity. So we know both components' fair value, and thus we are allowed to do the proportional method, because to do the proportional method we need to know the fair value of each separate piece, both the debt and the equity. Doing the calculation here, we first need to start to know what the total amount of the fair value of the bundle is. And when you do this, you will take the $980,000 for the bonds plus the $25,000. Therefore, it is $1,005,000 is the total fair value bundle. The actual amounts of proceeds that we received was $1 million, and that is the 1,000 bonds times the 1,000 each per, or $1,000 par value for each bond. So determine what the bond allocation is. The total amount of the proceeds that need to be allocated, we have to do the fair value of the bonds, which is the $980,000, divided by the aggregate fair value, and this I will put this aggregate because this is how we referred to it in chapter 15, times the actual amount of proceeds issued. So for the bonds would receive $975,124 of the total proceeds received allocated to the bonds. So when you record your entry, the debt component would receive that balance. The leftover amount of the actual proceeds is allocated to the stock warrants, is 24,876, and you can see the calculation is very similar to what we just did with the bonds. If you need to refresh yourself to make sure you understand the proportional method concept, I would refer back to chapter 15 as an additional example to this, but it is accounted for the same. You need to know the fair value of each. You need to know what the total fair value is, determine what the percentage of that aggregate fair value is for each, the debt and the equity, and then you will multiply that by the actual issue proceeds, and then that is the allocation amount to that, each one, debt and equity. Similar to chapter 15, the incremental method is used when the fair value of only one of the pieces is known, either the debt or the equity. But no, for this course, this class specifically, we will focus only on the proportional method, but that is just consistent with chapter 15, in which you would know one piece but not the other. Next, let's focus on non-detachable stock warrants. This is very important. They are accounted for as 100% debt. There is no value allocated towards the equity portion. Therefore, this calculation we just did here for the proportional method only applies to detachable stock warrants. And that is because each piece can be traded separately, thus each can have its own value. Non-detachable stock warrants, the stock warrants cannot be traded separately, thus they do not have a separate value than the debt itself. Therefore, you record the entire thing as debt and no value is allocated towards the equity portion. Next, let's focus on restricted stock. This is similar in idea to stock options, as it is a transfer of shares to an employee subject to an agreement that the shares cannot be sold, transferred, or pledged until vested. This is a very important thing and a major advantage of the restricted stock for companies, that it better aligns the employees' incentives with the company's incentives, as it makes them more of a long-term shareholder. Therefore, if I am at a company and on day one the company says we are going to give you 10,000 shares of restricted stock upon 5 years of service. Therefore, if you stay with us for 5 years, you cannot you cannot sell those shares, you can't transfer, or you can't pledge them. You can do nothing with them. You have them, but you can't do anything with them until you are vested. So that way it does line up with the long-term approach for a company by you being long-term focused as well, because you're looking towards that vesting date in 5 years, because then you will be able to do whatever you want with those shares and therefore be able to reap any benefits if the value of the stock goes up versus what you acquire, you got them for from the company. Employee stock purchase plans. These are stock purchase plans that generally allow all of the employees at a company to buy stock at a discounted price for a shorter period of time. The key thing with employee stock purchase plans is whether or not they are regarded as compensation for the employees or non-compensation for the employees. So, unless they satisfy all three conditions shown in this course packet here, it is considered compensation for the employees, and thus the company has to record an associated expense. However, if all three of these are satisfied, it is not considered compensation for the employees. And those three requirements are to substantially all full-time employees may participate, the discount from the market price is small, and the plan offers no substantive option features. So, therefore, just a reminder, they are considered compensation unless they meet all three of the following. If they meet two of the three, it is considered compensation. They have to meet all three to be considered non-compensatory. Disclosure of compensation plans. Companies must fully disclose the status of their compensation plans at the end of each period presented in the financial statement. These disclosures can be quite extensive. There's an illustration 16-5 on page 898 in the textbook for an example. However, you will not be required to know this in any detail. I just wanted to provide you a little bit of information as an understanding of how extensive these disclosures can be for these compensation plans. That will be the end of this part of the lecture. The next lecture we will pick up with earnings per share. But before we go, I would like to give a brief recap here of what we covered so far and some of the key things to note. First, focus on dilutive securities and what they represent, and why they are referred to as dilutive securities. Understand the reasons for issuing the convertible debt and the reasons for purchasing the convertible debt. Remember that for the accounting for convertible bonds that you use the book value approach, and therefore the debt comes off the book and the equity goes on, and there is no gain or loss at the conversion date. Remember that what sweeteners are used for, and that is to encourage the prompt conversion. And companies will offer that sweetener because it is more beneficial for them for you to convert than maintain the convertible debt. Remember that when accounting for convertible preferred stock at the conversion date, it is simply a book value trade between preferred stock and common stock. Preferred stock comes off, common stock goes on, and that there's no gain or loss on the equity transactions. Remember that stock warrants represent certificates entitling the holder to acquire shares at a certain price within a certain period. Remember the difference between detachable and non-detachable stock warrants and the difference in how they are accounted for. Detachable stock warrants are allowed to follow the proportional method because the warrants have a separate value because they are traded separately. Whereas non-detachable stock warrants, they cannot be traded separately, thus they do not have a separate value and they are recorded as 100% debt. And remember the understanding of what the major advantages is for restricted stock between a company and its employees. That is all for today. As I said, the next one, maybe two additional lectures will be covering earnings per share. If you have any questions on this material, please let me know. I will say that with respect to chapter 16, earnings per share, as we go into the next lectures, those will be the primary calculation components of your homework, quiz, or exam, as it has a lot of detail in terms of how you calculate the different parts and components of the earnings per share calculation. However, the material we covered today does provide some calculations, such as detachable stock warrants and then the accounting for preferred stock, convertible preferred stock, and convertible debt. But I just wanted to make you aware that a lot of your analysis in terms of calculations and computational problems will be revolved around earnings per share. That does not mean you do not need to know how to calculate these other ones, but I just wanted to kind of give you in terms of where the computational focus of this chapter will be when you are tested. If you have any questions over this material, please let me know. Have a good day. Bye.